Okay, the webinar will begin now.
Hi, everyone. Thank you for joining us on this Thursday afternoon. My name is Wilhelmina Waldman, and I'm a philanthropy officer for the Northeast region of American Friends of Hebrew University. We're so pleased to introduce this AFHU-sponsored Plan Giving webinar. Today's topic is the 2023 Legacy IRA Act, using tax-free IRA distributions for lifetime income, presented by the esteemed attorney Neil Meyerberg. Neil has extensive experience in tax and financial planning strategies with an emphasis on charitable giving techniques. He's going to share his expert advice with us on the retirement income strategies that may be available to you thanks to the Legacy IRA Act, and how you may be able to use tax-free IRA distributions as a source of lifetime income. As many of you know, American Friends of the Hebrew University is proud to present this webinar on planned giving, as we have done in the past. We want to help you do well while you are doing good. And the good, of course, is joining with AFHU in raising awareness and funds for the Hebrew University of Jerusalem. Hebrew University is Israel's premier institution of higher learning, with a commitment to delivering a quality education to its diverse student body while producing world-class research and dynamic innovation. HU has developed a global reputation for excellence, with the latest Shanghai academic ranking of world universities placing HU among the top 5% of universities worldwide, as well as the leading university in Israel. American Friends of the Hebrew University is proud to present this webinar as part of our ongoing efforts to develop a community of support for the academic excellence, cutting-edge research, and enterprising innovation that the Hebrew University provides in service to Israel and people throughout the world. Again, thank you for joining us. I know that many of you are members of our Einstein Visionary Society, and we appreciate your support. And we are looking forward to a great presentation by Mr. Meyerberg. Take it away. Thank you.
Thanks, Wilhelmina, and welcome everybody. Hopefully you can hear and you will see the screen in front of you, which announces the title of the webinar. A couple of things to be alert to. Number one, this is being recorded, so you'll have access to it if you wish by just letting us know. Number two, the PowerPoint presentation you'll be seeing can also be made available to you. And lastly, and hopefully will become interactive, you can ask any questions you want throughout using the Q&A box on the screen. And those questions will be fielded and sent over to me, and I'll respond to you. And if there are questions you have that we don't cover, or you would like to ask at a different time, you can always contact me directly through AFHU, or you'll notice at the very end of our presentation some websites and some email addresses. But essentially, we're going to talk about something which I think is very exciting, and it's brand new. This whole idea of the new Secure Act that was passed by the Congress, signed by the President, taking effect January 1, 2023, and something within it called the Legacy IRA Act, which is going to enable us to do things that we could never do before. So let's talk about a generic piece first before we get into the actual act. Since everything we're going to do through the act could possibly generate a charitable gift annuity or a charitable remainder trust, which means income for life or lives. A gift annuity, which many of you probably know about already, is simply a contribution made to a charity that is authorized by state law to issue gift annuities, usually just cash or marketable securities. And a rate is fixed based upon your age to your nearest birthday, or ages to two people's nearest birthdays. And it's payment made to you in a fixed amount for life or lives. Some of that payment, sometimes substantial amount of that payment, is made to you tax-free. There is a charitable deduction. That's the traditional way a gift annuity has worked, and many of you have probably tried this on your own and perhaps have gift annuities. But I use this as the prelude because we're going to talk about feeding into something like a life income plan in order to be able to make distributions from an IRA tax-free. So historically, there was a code section you can see on the top of the screen that made what was called qualified charitable distributions by definition. We'll call them QCD going forward. And the way the law was made permanent in 2015, before that, it was a law that had to be renewed every year. But in 2015, the law was made permanent. And that law before the IRA Legacy Act said that if you made a contribution to a charitable organization outright from your IRA, and you were over the age of 70 and a half or 72, depends upon the moment, then any of those contributions you made to charity during the course of a calendar year would be contributions made from an IRA where you don't pay tax on that amount. So it was tax-free payments. You could do it up to $100,000 in any particular year. And if you're over a certain age, that meant that some of the money you took out of your IRA, some of it, of course, is required minimum distributions, RMDs, could be sent to charity and not pay tax on. You wouldn't have a charitable deduction for that. You wouldn't receive income for it, but you'd make a contribution, which many of you do anyway, and you do it with tax-free IRA money. You could not use that money other than outright gifts to charity. You couldn't use it for a donor advised fund. You couldn't use it for a private foundation or supporting organization, and you couldn't use it to generate income for yourself. That was pretty clear. So therefore, specifically, you couldn't use a QCD to fund a charitable gift annuity or charitable remainder trust because you weren't permitted to receive income from the contribution. Now, we come to Secure Act 2.0, the new act that was just passed, and we have in there Section 307 called the Legacy IRA Act. Very, very interesting and very, very forward-thinking. For years, the charitable sector had attempted to get Congress to allow QCDs to be used for life income plans. They were saying to the Congress, well, if money comes out of the IRA, and if it's going to be used to create a life income plan, the end of that plan is going to go to charity anyway. There won't be any income tax deduction, and the income would be ordinary income, but at least the money could come out to buy a life income plan, and the Congress said no. Initially, we were asking the Congress if you were 59 and a half or over, and you could use up to $400,000 from an IRA to create these kind of plans, and the Congress never got out of committee, even though the payments would have been ordinary income, never got reported out, despite proposals that raised the age and limited the amount, still couldn't do it. You had traditional QCDs of outright gifts to charity. Then the act is passed, enacted as of January 1 this year, and put into the law what we're going to call and what is called the Legacy IRA Act. Legacy, I suspect, because it provides for charity. IRA, because it's used through an IRA, not through a 401k or any of those things. But of course, you can roll those over into an IRA before you do this, and that's not a taxable event. And the law provides that if you're 70 and a half or over, you can distribute from your IRA up to a lifetime maximum of $50,000 as a QCD to establish one or more gift annuities or CRTs in a single calendar year. Let's look at the components I just described. The most you can use is $50,000. You need not use it all, but that's the maximum you can use. You can use it to create income for yourself, either using a qualified distribution for a gift annuity or charitable remainder trust. It has to be done in a single calendar year. You can't use $20,000 in 2023 and the balance $30,000 in 2024. Must be in a single calendar year. So you want to choose your year, and it comes out based upon the value that you're using for the gift annuity or the CRT, and you're not taxed on it. So the fundamental question I'm going to ask now, and I'm going to answer later on, is could that $50,000 coming out for a gift annuity or a charitable remainder trust be all or a portion of your RMD? And the answer is yes. It's an aggregate amount, $50,000, one time only. Questions always asked, because it took for a long time for the QCDs that I described before to become permanent law, is a possibility that the Congress will allow this, once it's tested, to be year by year by year. You could do it in 2023, again in 2024, again in 2025. The answer is we don't know, but we're certainly going to continue to pursue the idea. If it works well, it's good for charity. It doesn't cost the Treasury a great deal of money ultimately because of the way the annuity is going to be taxed when you receive it. Maybe there will be extended years with the same right to do it. But right now, it's an aggregate amount. It only can be done one time in 1 year. Now, it does have an adjustment factor based upon inflation percentages. So therefore, If you believe that $50,000 based upon an inflation factor is going to be worth more than $50,000, it will state more than $50,000 in 2024, you can wait till 2024, see what the maximum amount will be then. Likely it'll be greater somewhat than $50,000, and do your aggregate contributions in the 1 year, as is required, in 2024. We don't know what that inflation factor will be, but we do know that inflation is still running about. So that may be a plan, but nevertheless, to be clear, $50,000, age 70 and a half, 1 year only for gift annuities or charitable remainder trust in the aggregate. So looking at it based upon the rules, who can be the beneficiaries of the gift annuity or CRT? Could it be your children, your grandchildren, a partner, but not a spouse? No, the answer is very specific. The beneficiaries of the gift annuity or the charitable remainder trust that you create with this IRA distribution, tax-free IRA distribution, may either be the IRA owner and or the IRA owner's spouse. The gift annuity must be immediate. It can't be deferred. Therefore, you can't create the gift annuity and say, we're both ages 72. We've decided we don't want our first payment till 80, which you could do with a normal gift annuity. You can't do that. The payments must be based upon what we call immediate gift annuity payments. Has to be the IRA owner and or the IRA owner's spouse. No one else can be beneficiary of these charitable gift annuities or charitable remainder trusts. In exchange for the fact that the money's coming out of the IRA tax-free, which may mean your RMD is tax-free, received by you from the gift annuity or the charitable remainder trust will be taxed as ordinary income. I'll show you in a moment that if you did a gift annuity with IRA money that wasn't going to be Legacy IRA Act money, that's essentially cash, some of your annual payments from the gift annuity would be tax-free. We have to measure and weigh whether the tax-free payments and the charitable deduction is better for you than taking the money out of the IRA tax-free and creating this Legacy IRA. That's something you and your accountant will look at much more carefully. No income tax deduction, that rule governs all QCDs, whether it be the ones you gave outright to charity or now the ones you use on the Legacy IRA to create a gift annuity or CRT. There's no charitable deduction. Why? The government's saying, we're not going to charge you income tax, therefore we're not going to give you a charitable deduction. The beneficiaries of the charitable gift annuity, you and or spouse, or both of you, can't assign the benefit to anybody else. Can't even assign it to the charity. You have to take it, you have to receive it for the balance of your life or lives. The fixed rate in the gift annuity or the charitable remainder trust, based upon tables of rates or charitable remainder trust rules that are IRS driven, can't be less than 5%. The fixed rate can't be less than 5%. Most of us would expect the rate to be considerably higher than 5%, but it can't be any lower than 5% based upon these rules. And this is something very interesting. It was asked of me a week or so ago, and that is, when you do a gift annuity, the benefit of the gift annuity goes to the charity who is issuing the gift annuity to you, the contract. No other charity can share in that. In a charitable remainder trust, the remainder goes to a charitable beneficiary. Doesn't have to be the charity that you're giving a gift annuity to because you're doing a separate trust. So I'm stating in the very bottom of this, it's possible that the remainder interest in a charitable remainder trust, QCD, based upon Legacy IRA, could be sent over at the end of lifetimes to your donor advised fund or to your family supporting organization, supporting foundation. So when asked a week or so by somebody, can I create a charitable remainder trust, my wife and I, fund it with QCD money, each of us can use $50,000 and have the remainder payable to our donor advised fund at the Federation? The answer was and is yes. Some more rules. If both spouses have IRAs and they're both over 70 and a half, you can both use $50,000 from your respective IRAs to establish a 2-life joint and survivor gift annuity or charitable remainder trust. What that does in essence is it moves the $50,000 number to an aggregate of $100,000 number because spouses both have IRAs. On the side issue, which I'm often asked, if we create a gift annuity, or in the case of a charitable remainder trust, we create a charitable remainder trust with $50,000 or $100,000 if we're spouses, can we add to that charitable remainder trust with money that isn't IRA money or is taxable IRA money? So we want the trust to be, say, $200,000. $100,000 will be our IRA Legacy IRA Act money. Other $100,000 will be some of our savings or some of our IRA money that is taxable. Can we add to it to make our trust larger? Or can we have money added to it later on to make our trust larger? And the answer is you cannot do it because only funds that are QCD Legacy IRA Act withdrawals can be used to fund these instruments. Essentially, to summarize, the $50,000 or the $100,000 for a couple is the only amount you can use to create this gift annuity or the charitable remainder trust. You can't have other money added to it to make it larger, even though you would be taxed on that money. And lastly, and I'm saying it right here, it can be used to reduce or eliminate taxes on RMDs. So if you're using $50,000 in 2023, and your RMD in 2023 is $50,000 or less, perhaps, you could erase the entire RMD and tax on the RMD by using this strategy to create this life income plan. What's happening now that hadn't happened before is you can now use the money to generate income for yourself and not pay tax on it coming out. It can also apply to inherited IRAs, IRAs that many people inherit from family members. We were asked the question, well, inherited IRAs, which also require RMD distribution, can they be used if I'm an inherited owner to execute under the Legacy IRA Act? And the answer is yes. These are some of the rules for the Legacy IRA Act. Now, who can benefit from it? Why would anybody think about doing this in the first place? Well, a lot of people don't itemize. In fact, I think the data suggests that more people considerably than others don't itemize the deductions. They take the standard deduction. So the fact that you don't get a charitable deduction with a legacy IRA is a non-factor. It's like people say, well, I don't want to do it because by doing it, although I take the money out tax-free, I don't get a charitable deduction. If you don't itemize, it doesn't matter. You'll get a charitable deduction anyway. It's built into the standard deduction. So number one, people who don't itemize might find this to be a good strategy. Number two, since you're avoiding tax initially on the IRA distribution, paying no tax on it, only going to pay tax year by year on the money received from the life income plan, it's effectively an above the line deduction. It doesn't add to your adjusted gross income because it's not coming out as taxable income that you have to include in that calculation. Number three, it may be people who want to spread out income tax and one lifetime income. You would like the idea of having money coming out of your IRA, which could be used in this way to get lifetime income. You'll spread out your income tax costs. You're only going to pay income tax on that income. You're not going to pay income tax in one chunk on that distribution from the IRA. So essentially, it's another example why somebody might benefit from it because they want to spread out income tax. Number four, third time I probably said it because it's asked so often, I'm going to repeat it. No tax on RMDs if the RMD amount is in that $50,000 or some portion of the RMD, if it's greater than $50,000, will not be taxed the year you do this transaction. And lastly, and I think it applies to mostly, if not all of us on this call, on this webinar, people who want to do something for charity after your lifetimes. Many of you will do it in your wills, in your living trusts, through your life insurance, perhaps, through designations in your IRA, 401k, 403b, but you have a plan, end of life plan, perhaps, leave something for charities you believe in, including American Friends of Hebrew University and the university. It's a way to leave a legacy for them now, which they don't realize till later on, and get income for life. So individuals who want to leave a legacy for charity after lifetime are doing it through this matter, one of the ways they can do it, and receive income on the item or the amount you're dedicating to charity for the rest of your lives. These are who can benefit from a legacy IRA. So let's take some examples, make it more plain. These are based upon tables of rates for the American Friends of Hebrew University's gift annuity. Example number 1, done in March, this month, 2 individuals, 79 and 77, spouses. They each have IRAs. They each take $50,000 of their IRA to create a contribution from that IRA or those IRAs of $100,000, the maximum they could have done under the Act. The rate for the 2 of them, joint and survivor rate, is 6.2%. They'll be payable quarterly, each quarter. The first quarter will be the quarter that ends from the date that they make the contribution. Therefore, they will receive $6,200 each year as ordinary income. No charitable deduction, we've talked about that, but the money that's being used here is coming out of the IRA at no tax cost. The rate of payment is based upon 2 life tables that are filed by the charity with the New York regulator or the California regulators, and therefore this is the amount you'll receive as ordinary income. This is a 2 life joint and survivor spouses. Suppose you're an individual, you're 72 years of age, and I think this is kind of interesting because the way the numbers break out. The rate for a 72-year-old single life is 6.2% as well. Now you wonder, why would it be 6.2% for a 72-year-old and also 6.2% for individuals ages 79 and 77? It's based upon life expectancy. The life expectancy of 2 people ages 79 and 77, that is when the second of them will die, is almost identical to the life expectancy of an individual based upon age 72, just based upon actuarial tables, actuarial charts that the IRS makes use of. So this 72-year-old, doing it without spouse, takes $50,000 out of his or her IRA, creates a charitable gift annuity with AFHU at 6.2%. This number is incorrect here, but that should be changed. At 6.2. At 6.2%, therefore receiving $3,100 per year for life, and that money would be ordinary taxable income, no charitable deduction, fixed rate. Money comes out tax-free from the IRA. We have a stated rate. We know the amount. Pure, simple examples of a Legacy IRA Act gift annuity for a couple or for an individual. Now, suppose instead the couple was going to take the money out of an IRA, but it was going to be taxable IRA money, not QCD Legacy IRA Act money. So this is kind of the same instance. Same donor, age 72, whose life expectancy under the tables is 14.5%, who takes $50,000 out of the IRA, taxable money, creates a gift annuity for 6.2%, will get $3,100 a year, but gets a charitable deduction. It's based upon a number of factors, including life expectancy and the IRS discount rate for the month of March. That charitable deduction, if this is an itemizer, very important factor, and if the itemizer pays federal and state taxes at a combined marginal rate of 25%, it means that there'll be taxes charged, tax savings, I should say, because of this deduction of $5,442, which reduces the cost of this annuity, if you factor in the tax savings, to $44,558. Pure math. Here's my contribution. Here's what I save in taxes as a result. Here's what my net cost. My net cost divided into my annuity means I'm getting an effective return of 7%, and 62.8% of my annual annuity for a period of time will be taxed free, will not be taxed as ordinary income. This is a traditional IRA withdrawal using or cash out of your savings account without regard to not paying tax under Legacy IRA. Same with the couples.
I have a
If the couple do
question.
the same, yes,
You
question.
have a question? Can you do just 50K from one IRA, but make it joint upon survivorship of husband and spouse?
Absolutely, absolutely. Early slide says that you can be, the beneficiary can be spouses and or one spouse. So it can be joint and survivor using $50,000 out of the one spouse who is the IRA owner. Absolutely.
Thank you.
So in this example of my couple, ages 79 and 77, whose life expectancy, as you can see, is close to the life expectancy of the 72-year-old, the same gift annuity rate, $100,000 in this case, means it's double what it was in the prior screen, $6,200, a charitable deduction, which saves them taxes if they itemize, which reduces the cost, increases the effective rate, and their tax-free portion, because this is taxable money being used, 65.7% for the joint life expectancy. Now, important to look at this because I'm asked the question, and this is such a new field now. I'm asked the question, how do I compare using the legacy IRA withdrawal, which is tax-free, to create a gift annuity where I get all my income as ordinary income and get no charitable deduction, with not taking it out tax-free, taking it out taxable, and doing the same thing, but getting a deduction and getting tax-free income. And all we can do is look side by side. And this would take some analysis. You do your own analysis, I'm sure. It's all good information you can share with your tax planners, with your estate planners. But essentially, here's the couple, the legacy IRA couple, who get 6.2% with no charitable deduction. But this is the rate to get, this is what they're going to be paid for the rest of their lifetime. Each year, this is going to be taxed as ordinary income. Perhaps as they get older, their marginal rate gets lower and lower. So it's not a very substantial, but it will be an ordinary income tax. It'll be paid for them for the rest of their lifetime. Compared with the same couple who uses taxable money, IRA money perhaps, same rate, same payment, they're going to get the same amount, but they're going to get a charitable deduction, which stated as a percentage is about 42+% of the contribution. They're going to save some money if their marginal rate is 25% in tax savings, and they're going to get some tax-free income each year of the $6,200. I don't have a program yet, and I think we're going to design one where we can actually dig deep in this and analyze which, if we assume people are going to live normal life expectancy, is the better course of action. We can assume that some people will live less than the life expectancy. Some will live more, and as you suspect, the gift annuity doesn't end if you reached mathematical life expectancy, only ends when you reach true end of life. So the analysis of this takes a lot into consideration, but I thought it'd be interesting for you to see it side by side. The same with an individual. Same person, this is my 72-year-old who gets this rate, 6.2, and gets paid $3,100 a year for life, no charitable deduction. Probably not an itemizer, so the deduction wasn't going to make it different anyway, but does pay tax on the annuity. If you take out the deduction and only look at the question about whether you want tax-free income or not, it may lean more toward the legacy IRA because the deduction, which you can see saves taxes, would be inconsequential or of no consequence if you don't itemize. Let's assume you do itemize your rate, your payments, your deduction, which is consequential, your tax savings if you're an itemizer, your net cost, which is a gift less the tax savings, raises your rate and gives you the tax-free portion. It is a challenge. This is all so new. And so people, nevertheless, and I would report to you in the space of mid-January till now, about a 60-day space of time, so many inquiries are being made by people. But what's interesting about it is no one needs to rush into doing this. It is a transaction that can happen anytime in 2023, or if you want to wait till 2024, you can't predict gift annuity rates, but I can fairly assume that the gift annuity rates for American Friends of the University are not going to change in 2023, may not even change in 2024, and that may be the case with no charities. So therefore, all you can't predict if you do this in November as opposed to March is how much would the charitable deduction be in November if you chose to do the taxable IRA, and how much would the tax-free portion be in November? Why can't I know that now? Because it's based upon the IRS discount rate at the time we do this, which is a function of treasuries at that time. It's issued every month.
I have
So
a question,
essentially,
Neil.
yes, please.
I'm not sure if you covered this just now or not, but if the CGA is 6.6%, why is the payout rate 6.2%?
Well, what I did, I apologize to everybody, this chart right here, that 6.6% is a mistake. It should have been edited back to 6.2. That's the only reason why. I wish I had a magic answer for it, but it's simply a typo. 6.2 is correct. So lastly, just so you can see the rates, if you're doing a gift annuity with the American Friends of the Hebrew University, I did it in 5 multiples. 70-year-old, you can see the rate and the tax-free portion if it was done in March or April. 75, you can see the rate, single life, tax-free portion if you do it March or April. 80, rate, tax-free portion. 85, rate, tax-free portion. 90 and above, rate, tax-free portion. The tax-free portion, as I say, will be determined in the month you create the gift annuity. We know what the tax-free portion is going to be for March or April. A lot of material, a lot of information, and we did it in what we call our mini webinar speed to enable you to have a flavor for this and to ask questions either now or subsequent to this. We'll be happy to send you the outline, happy to send you the recording, and happy to take your questions by email offline and respond quickly to you in confidence. It's a new law. Will extend, will be renewed, will be year by year. We don't know. We do know that what we reported to you today are the rules as we see them now. And I didn't spend a lot of time talking about charitable remainder trust. So a much more complicated topic. Happy to talk to you about that again, separately with your questions. So Wilhelmina, we just gave a
So I
primer.
have one more question, Neil. I
Yes,
have one
Laura.
more question. Where can one find the rates for a single life and double life?
Well, we have a calculator, Laurie, on the website that enables people to get their own calculation by just going to afuture.org into plan giving, or in confidence, send us the date or dates of birth for you to us in confidence, and we'll send you back the calculation. That may be easier for you. Happy to do it either way. So you just get some information and know your rates.
Thank you.
Any more questions, Laura, you can see?
I think that's it. We're good. So Wilhelmina's good to go.
Okay. Well, thanks
Well,
everybody. Here, Wilhelmina,
Thank you
I'm turning it to
so
you.
much, Neil. What a comprehensive overview. A lot to think about, a lot of new laws, a lot of new rules. And I know that many of you will have follow-up questions and we'll have to have discussions with your financial advisors or your families. But we are here, as Neil said, the door is always open. You can contact me or Neil or any of your regional philanthropic advisors for American Friends of Hebrew University. And we do hope that you will stay in touch and consider joining our Einstein Visionary Society. There's some information about it in the chat, and you can contact us directly to join, or again, your regional advisor. We thank you very much for joining us this afternoon and hope that you have a wonderful rest of your day and weekend. Thank you for considering American Friends of Hebrew University in your legacy plans.
Good. Bye, everybody. Have a great day.
Bye.